Hello once again, I'm Kevin Turner from Real Estate Talk. Welcome to another one in the series of Ask Michael Anything. Joining us as usual, Michael Yardney from Metropole Property Strategist. Hi Michael.
Good morning, Kevin.
Michael, we have a question this time from Eric, who writes and says, with 1/3 of borrowers having little or no buffer and the interest rates pretty much on the upside, not to mention the completion of the number of apartments and land releases, how much correction do you think we might be facing in the Sydney and Melbourne markets?
Good question, Eric. That's a lot on the mind of a lot of people at the moment, because some commentators are saying that property markets have topped. Well, let's be clear that there's not just one Sydney and one Melbourne property market, so different segments will be affected differently. You're right that interest rates are on the upside, so those people who are a little bit more interest rate sensitive are likely to be affected more, aren't they? So in my mind, investors who've just got into the market, who've committed themselves, who've taken high loan to value ratios, or first home buyers, or buyers who've extended themselves. So you're going to find that property values are going to drop a little bit more in blue collar areas where people's wages aren't going to go up as much, in new home estates, and in a lot of those new and off the plan apartment blocks where there's been a preponderance of investors who've overcommitted themselves and are going to wonder what's going on. I think holiday homes and holiday locations and some of the regional areas where people don't need to have another holiday home or a secondary holiday home, they're probably also going to drop a little bit as well. And you'll find the high end of the market tends to suffer more as the market turns, because you don't need a $10 million trophy home in Rose Bay when maybe a $5 million one is going to work well enough for you. But interestingly, in the middle and inner ring suburbs where people have still got jobs, they're still getting married, they're still getting having babies, they're still moving on with their life, they're upgrading, they're downgrading their homes, they've got jobs, they've got good incomes. Those areas didn't suffer much during the global financial crisis. Those areas didn't suffer much during the downturn of 2000 2003, or I remember even in the 1990s. They could well drop 5%, 6%, maybe 7%. They're not going to drop 10, 15, 20% because people aren't going to have to sell up their houses and give up their houses, Eric. The interesting thing, though, is it's not going to happen overnight. It'll happen over a short period of time. And if you think about it, all that does is take us back in price 6 months. And then slowly the market will turn, interest rates will be lowered a bit, or the banks will loosen their serviceability criteria because they don't want our property markets to drop in value much at all, and the market will move on. That's what happens. That's what happens in property cycles. You've got to be prepared for it, Eric. You've got to have the financial buffers to see you through. And if you hold on in the long term, if you've got a good investment property, you should do really well, Eric.
Yeah, it's a good point you make there too about buffers, and that was one part of Eric's question, wasn't it? That 1/3 of borrowers have very little or no buffer, which really should be a big concern for those people.
You're right, Kevin. You can't count on rental growth happening continuously. You can't count on capital growth being as strong in the next couple of years as it was before. But a lot of beginning investors are coming in with their eyes half shut, I guess. They don't really realise what happens at this stage of the more mature stage of the property cycle.
Well, it's good talking to you, Michael, and thank you for your question, Eric. Keep those questions coming in too, by the way. You can send them in through the website, and we'd love to get your questions and put them to Michael. Michael, thanks again for your time. We'll catch you next time.
My pleasure, Kevin.